Now, there was a lot of other results out this week. We've got a little package here from Kate Tozer, which is a wrap-up of what's been happening.
Commonwealth's $7.1 billion profit set an Australian banking record this week, but it came at the expense of 1,200 jobs. Increased takings at Coles and Kmart boosted Wesfarmers' bottom line, sending shares to an 18-month high, while Westfield's decision to cut loose underperforming shopping centres seems to be paying off. Domino Pizza dished up a 27% profit increase. AMP was rewarded for tightening the purse strings in absorbing AXA Asia Pacific, and a huge restructure at Goodman Fielder came at a cost, but investors piled in anyway. A retail nervous market sighed with relief when JB Hi-Fi's profit shrank by only 5%. Newcrest Mining thanked the strong gold price and an asset sale for its record profit, and engineering firm UGL booked a 15% earnings slump and warned of tough times ahead. On the flip side, Downer EDI beat expectations with a $193 million full-year result, driven by strong growth in the mining division. Brambles' share price nosedived on news of its 21% profit jump, but they soon recovered. And QBE had a better half thanks to increased premiums and fewer claims.
So what's your overall impression, just before we get into details, the overall impression of the profit season so far?
Well, the results have been pretty mixed. I mean, look at Downer and UGL. They're both in roughly similar businesses, and yet one did well and one didn't. But I would say that overall the outlook statements are still pretty grim, and I think Australian managers, CEOs, are sort of realising that under-promising and overachieving is what the market rewards at the moment.
What do you think of the outlook statements, Liz?
Yeah, I think the outlook statements are pretty much saying more of the same for the entire year, which is not really all that encouraging, because I mean, yet there have been a few standouts, which we've seen. Car sales was another one, which was just fantastic. But on the whole, I think they've been pretty disappointing and reflective of the economic times and the structural problems that many companies are actually feeling.
As Kate said, CBA's profit, $7.1 billion, was a standout. Here's CEO Ian Narev.
It is a big absolute number, but we're a big business. And as it stands, I think on market cap terms, we're about the fourth or fifth largest financial institution outside of China. That's as much a function of what others aren't doing as what we are doing, but the reality is we're a big business, and big businesses earn big absolute amounts of money.
The banks always have to say that, don't they? Oh, we know it's not that big. And
I know they're making excuses for being successful because it's
so
politically
the banks have been doing that for years.
Unpopular to make money.
It is. I mean, poor old Ian Narev, you know, it's his big chance to crow. And he really can't, because then he just annoys his customers who are saying that they're being ripped off with too higher interest rates. But no, that was an excellent result in these times. But the banks seem to come up with it every time, don't they? Regardless of, you know, the cost of money being more expensive, deposits being more, they seem to always come up with a reasonable return.
We do have a great habit of whinging about strange things here in Australia. I mean, one thing the financial crisis taught it was if there's only one thing worse than having really profitable banks, it's having really unprofitable ones, and that's what the rest of the world has, and they complain about that, and here we are with money coming out of their ears. Look, it should be celebrated, but it's not.
Useless statistic, 52% of the recent 9% rally we've had in the market, 52% of it has come from the four banks on their own. They've had a great rally, which of course a lot of people miss because they're worried about some European event, as I was, worrying about a European event, and of course they're the most vulnerable. And here
well,
they
of course, the reason they're buying the bank's shares is for the dividend, right?
True.
And Citibank, global equity team, put out a note to investors worldwide suggesting they should be buying banks for the yield. And here's the list. The NAB and the Westpac are right out in front with a nominal yield of about 7%. The ANZ and the CBA not far behind. And they're ahead of the benchmark MSCI high dividend yield index, US Treasuries and German bonds. So really, Australian banks stand out in the world of yield, not just in Australia.
Well, no, the interesting thing about that is that was a European note going to international investors who don't get franking. So, in other words, the yields are now so high they're even above the other sort of income-producing things. But, you know, yeah, we know that. You know, they just woke up to the fact we've got some high-yielding banks in Europe. You know, it's not the point. The point is what the share price is doing.
Well, and to compare them to, you know, German bonds or US Treasuries is dumb. I mean, those things virtually pay no interest anymore because people are rushing into them. And look, Australian companies in general, not just banks, have always been high dividend payers by international standards, thanks to franking. You know, in America, it's unusual for any sort of company to pay more than 2 or 3% per annum. They say it's better to reinvest the money in your business. So I think our dividends are just reflective of our investment culture.
Yeah, and chasing yields is, exactly, is something that Australians love to do. And it's actually worked quite well. And I do take Marcus's point. Obviously, a yield is fine, but if the share price is falling. But there are, I think generally that our banks are sufficiently secure that we shouldn't have to worry too much about capital losses on that. So they're an attractive yield play,
Well,
definitely.
in fact, we've got a nice graph.
They fell 54% in the GFC. I think we do have to worry about capital on.
Well, look at
banks.
it. We've got a graph of Westpac's share price, just as an illustration of that, Marcus.
Well, this is Westpac since the GFC, and this just shows you how many times the share price goes up and down. If you can see those percentages for a stock that yields sort of 7%. Who gives a rat's about the yield when the share price is doing that? The share price of these things is everything, and there's a long story behind it. But I believe investing for income is a bit of a joke, and too many people do it. And because they're focused on income, they lose sight of the capital going up and down.
It's a joke, Tom. You've got a high-yielding fund.
I don't know about a joke, but look, I will say this: I do run a high-yield portfolio, and it has rallied substantially in the past few months.
Because income is currently a flavour sector, but it's not so much the yield; it's the lack of yield in term deposits, which has driven people into it. But they're going to get a real whip in the tail when those sectors go wrong, when the share prices go wrong.
I briefly worked as a broker when I was very young, and one of the things I was told was, when the market's going down, talk about the yield. When the market's going up, forget the yield and talk about the capital appreciation. And again, I think that aphorism is still true.
I'm sure that hasn't changed at all.
It's total return, and the yield is a tiny part of total return, and the volatility on banks makes the yield largely irrelevant. We've been spoilt by 10 years of the banks going up in the 90s, where we thought we deserve capital growth and income. It's rubbish. Capital is everything. In a risky market like this, holding a stock because it's got a high yield is just missing the point. Total return's everything.
You're in a minority there. I think most of Australia.
But I need to teach the whole of Australia about it. I do an hour's lecture on it.
Well, let's keep it.
I'll start.
The show's only half an hour, Marcus. Sorry.